Okay. So today is April 15th. The information in today's presentation is current up through yesterday, so it doesn't include any market activity today. I'll start by going over the same chart that I've been using since the very beginning of this crisis to kind of help you understand how, as an economic crisis, this coronavirus COVID-19 crisis has developed. As I've described in the past, I see this crisis in terms of achieving up to 4 different levels of severity. The first level of severity started as really just a supply chain problem, then quickly evolved into a worker productivity problem. It became very serious when it was clear that consumer spending and business investment would be dramatically affected by this crisis, and that's when we hit what is our current level of severity, a level 3 crisis. We are still in a level 3 crisis. What I am most concerned about is whether or not we eventually reach a level 4 crisis, which I describe as a global and US debt crisis. I've described in the past some of the events I'm on the lookout for that I think might trigger a crisis like that, either a debt crisis in a country like Italy or Spain, which has been hit especially hard, both in terms of public health, but also in economics. And then here in the US, I'm looking for banks to have problems meeting their capital requirements. I'm looking for previously investment grade rated companies fall to below investment grade and then begin to default or file bankruptcy, which has not happened yet. And then I'm looking for unemployment to possibly get to a very high level. And I've told you in the past that I kind of picked 20% out of the air because we don't really have much to compare that to historically as to what would be an especially severe level of unemployment. Currently, we're at a level of unemployment of about 10% today, but that is about a 2-week lag in those numbers. So we don't really know how bad it'll get, but we know it will continue to get worse from there. Also on this chart, I have plotted the S&P 500's performance year to date in the blue line. You can see that at the depths of this crisis, right around March 23rd, March 24th, the S&P 500 had dropped more than 30%. It has since recovered a ton of territory since then. Now the S&P 500 stands year to date down only about 12%. You can see that that recovery happened at the same time that the confirmed cases of coronavirus continued to escalate, both globally and here in the US. And so why, the question of why the market has continued to go up in value from the bottom has been a question that's really plagued me the last couple weeks. And I'm going to take you through what I hope will be a bit of an explanation of that today. Also on this chart are some notes about how things have changed since the last time we touched base with each other. So just 8 days ago, we had our last Zoom call. And since then, in those past 8 days, we've seen global cases of the coronavirus increase by 70%. We've seen US cases, confirmed US cases, double just in the last 8 days. There are the beginnings of some hope that maybe this curve is flattening out, that maybe we're reaching the peak, but don't be fooled. Just because we've reached a peak or we are reaching a peak does not mean the worst is behind us economically, okay? All right, if I strip out some of that extra info there, you know, we can really just kind of focus in on what I was talking about. This huge increase that we've seen in the S&P 500 from the bottom until now. And that's part of what concerns me right now. Is why have we had this big increase in the value of the S&P 500, and are we set for you know, just the opposite to happen, for another crash in its value? Now, to better understand why the S&P 500, why the U.S. stock market is doing what it's doing, it's important to understand what the S&P 500 is, okay? It is an index that is based on the value of the stocks of the 500 largest companies here in the US, okay? And if we take those companies and divide them into categories, which the market calls sectors, you can see what makes up the price of the S&P 500. Okay? It is not an equally weighted. It is not an equally weighted index. All right, information technology companies make up 25% of the price at any given time of the S&P 500. Okay, the next largest sector is healthcare, which makes up 15%. Financials at 10%. Communication services at 10%. Communication services include Facebook and Google. Okay, they're called communication services when you break it down into sectors. You know, energy, material, real estate, utilities, all of these, you know, don't impact the price of the S&P 500 very much. All right. So what that means is if technology is doing really, really, really well and everything else is not doing so well, the S&P 500 will seem artificially high compared to the rest of the economy. Okay. So I'm taking you through this analysis because I want to drive home the point that the S&P 500 is not a representation of the US economy. It's a representation of the largest part of the US stock market. All right, let's get even further down into the weeds. All right, this is kind of a crazy chart showing all the companies that make up the S&P 500, okay? The larger the box is, the larger part of the S&P 500 it is. The smaller the box, the smaller the part of the S&P 500 it is, okay? The three largest boxes in this chart are Amazon, Microsoft, and Apple. Together, they make up 15% of the S&P 500, okay? So no matter what the S&P 500 does, 15% of the price that's reported every day is going to be based on the price of Amazon stock, Microsoft stock, and Apple stock. Amazon and Microsoft are both doing very well through this crisis. Amazon up 23% in the last 3 months. Almost unbelievable if the reality of our lives weren't that Amazon is delivering half of what we consume right now. At least half of what we consume right now is being purchased and delivered through Amazon. Microsoft doing very well. Their gaming platforms are doing very well. Everyone is dependent on their software right now. Their stock is up. Apple's taken a bit of a hit, a large hit, because a lot of their sales are made up from iPhone sales, and people aren't buying new iPhones right now. Also, their supply chain heavily dependent on China, which at the beginning of this crisis and continues today, that supply chain has been disrupted. The green parts of this chart indicate that those companies have actually increased in their stock price. Their stock price has increased in the last 3 months. All of the other red sections are stocks that have decreased in price. If we look at some of these other green areas, okay, Walmart and Costco, they're doing just fine through this, okay? Drug companies, all right, they're doing just fine through this crisis. In the real estate sector, REITs that own wireless towers, those are doing pretty darn well right now, okay? Netflix, they're doing just fine, okay? What is not doing very well at all? Chevron and Exxon, okay? The energy sector got hit by a dramatic drop in oil prices. That part of this economic crisis has been a little bit overshadowed, a lot overshadowed by the coronavirus. But unfortunately, at the same time this coronavirus took over the world, Saudi Arabia and Russia decided to flood the world market with oil. Some of that has depleted in the last couple weeks as they've agreed to cut production, but energy stocks have been just slammed. All right, let's have just a little bit of fun because, you know, why not? Why don't we play a little game? All right, all of you guys are going to play this little game at home. It's going to be on the honor system, but if you get all 4 of these questions right, I want you to email me and I'm going to send you a $10 Amazon gift card. just because why not? It's fun, okay? So here's the quiz. I have over here a list of the top 10 companies making up the S&P 500. You have to guess which decade this list is from. Is it from the 1980s, the 1990s, the 2000s, or the 2010s? Okay, so make a little note, take a second, make a little note. We've got GE, we've got AT&T, ExxonMobil, Coca-Cola, and Merck. If you said the 1990s, so far you got 1 for 1. Good job. Let's try to get another look. Okay, new decade, new list of top 10 companies in the S&P 500. Now we've got Apple, ExxonMobil, Google, Microsoft, GE, Johnson & Johnson. Which decade is this list from?
2000s.
Hey, no cheating, Jamie. 2010s. This is the decade of 2010 was this list, which is the most, not the current list, but the most current list of the ones I'm going to show. All right, if you got that right, you're 2 for 2. All right, the third one, here we go. IBM, ExxonMobil, GE, AT&T, GM, and Shell. What decade is this top 10 list from? If you said the 1980s, you were right. Congratulations. All right, last one. Here we go. 4 for 4. Hopefully, if you've gotten all 3 right, you'll get the 4th one right. The last decade, we got GE, ExxonMobil, Microsoft, Citigroup, and P&G. That is from the 2000s. So if you got all 4 of them right, send me an email, and I want to send you a gift. I want to send you an Amazon gift card. We got to support their stock after all, since they're only up 23% year to date. All right, so now that we've kind of taken a spotlight into the S&P 500, which are the largest companies in the US, I want you to understand that the S&P 500, those companies do make up a part of your portfolio, okay? But it's not all of your portfolio. It's not even most of your portfolio. Okay, here's a list of all the different asset classes we are currently managing in our clients' portfolios. Okay, I have them ordered with their returns by asset class. Okay, I also have shown you here what the weightings are of each of those types of assets in not every single one of your portfolios, because you guys do have different portfolios, but in kind of our average portfolio. So small cap equity, US small cap equity has taken the biggest hit during this crisis, okay, down 25% year to date. But it only makes up a small 4% of your portfolio, most of your portfolios, okay? International equity has been the next hardest hit by this crisis, okay, down 21%. That does make up a decent part of most of your portfolios. We've maintained a pretty robust international stock allocation through the last decade. It is questionable whether that has paid off. There is no doubt that there is some diversification benefit to owning stocks that are not all here in the US, but the performance of international stocks compared to the US economy, the US stock market, over the last decade just hasn't been what it was in the previous decades. That's one of the biggest questions going forward as a portfolio manager is how much international equity does it still make sense to own? Mid-cap equity here in the US, middle-sized companies have also been hit pretty hard, followed by real assets, including real estate and commodities. Here we have large cap companies. This is the closest comparison to the S&P 500 right here, down about 13%. Then we have some of the fixed income groups. Down on the very bottom here, we have your best performing assets, cash, and not surprisingly, fixed income. Now, fixed income is one of the largest pieces of most of your portfolios, okay? Our average client has at least 20% in US high quality fixed income. This is where that cash flow is going to come from, cash and fixed income, the assets that are either flat or up year to date through this crisis. Now, if I put it all together, most of you will own one of these 4 different types of portfolios that I use for clients. Okay, if you're 10 years or 7 to 10 years away from retiring, you're probably in either the growth portfolio or my all equity portfolio. Most of you guys that are that far away from retirement will be in the growth portfolio. However, if you guys are currently retired or within about 5 years of retirement, I probably have you guys either my growth and income portfolio or my income portfolio, okay? These two portfolios make up by far the majority of my client assets, okay? And are only down between 7 to 10%. Now I say only, not to minimize the real pain that I know you guys are feeling through this crisis, but I say only because it's well within the stress testing that we've done on our portfolios, on our projections that we've done for you guys. You may recall in the retirement projections that we've done, we do a stress test called bad timing. Okay, bad timing means we've tested the portfolio against a 2-year 30% drop in the value of the portfolio. Okay, and it's only if the cash flow that we've promised you, it's only if we can keep that cash flow up despite a 2-year 30% drop in the portfolio, do we tell you that that retirement projection is a valid plan, that we can do it. Okay, so all of the conclusions we've given you are based on that 30% drop test. So any client who is retired, who has suffered a 7 to 10% drop in their portfolio, you still got a long way to go before we start being concerned about the reliability of the cash flow that we've promised you. I also kind of want to give you an idea about how this crash so far, as we stand today, stacks up against some of the big drops we've had in the last couple decades, okay? Just in recent history, right, we've got the subprime crisis in 2008. We've got what we're calling the debt ceiling crisis in 2011, and then the China slowdown drop that we had just recently in 2015, okay? We suffered through all three of these most recent crises as part of the most recent bear market bull market that just ended. Okay, so in the subprime crisis, we saw our income portfolio drop about 13%. Today, the drop is half that, only about 7.5%. Okay, in 2020, we saw our growth portfolio drop about 30%. The drop so far in the growth portfolio is only about a third of what we saw in 2008. So comparing today's crisis investment-wise to 2008, it's not even in the same league. It's actually much closer to these two other crises that we've had since then, the debt ceiling crisis and the China slowdown crisis, both where we saw drops in the portfolio similar to those two instances. So what are we doing going forward? Well, we've had a strategic investment plan in place for 2 years now, preparing for a coming recession that we are now in. The first step was to build up a war chest that we could use to provide you with cash flow through this crisis and an opportunity to rebalance back into the market as it dropped. Currently, right now, we're doing these two activities. We're rebalancing the portfolio to sell high and buy low, and we're doing tax loss harvesting in non-retirement accounts to generate some valuable tax deductions on future tax returns. Also, going forward, as you need cash flow from your portfolio, we're selling defensive investments that are either flat or up to create the cash flow that you need going forward. Okay, this is a chart you've seen before showing you kind of our strategy graphically, that 2 years ago we created that war chest. A year ago, we added to that war chest, bringing it to about 15% of your portfolio. Today, we're starting to re-implement that war chest back into the portfolio, and we'll continue doing that for about the next 10 months or so. Right now, today, tomorrow, and Friday, we'll be doing the second round of rebalancing back into the market from that war chest that we built up. All right, that concludes my part of the presentation today, giving you an idea about what the market's done since we met last, what we are doing as far as a portfolio management strategy, and kind of giving you an idea about why the market is what it is and how this crash compares to things we've all been through together in the last 10 to 15 years. I now want to turn it over to Gregg Bruno, who can give us an idea about what the residential real estate market is doing and answer any of your questions about your own personal either investment or primary residence real estate investments. So I'm going to stop sharing my screen now and turn it over to Gregg.
Thank you, John. And I think when I start talking, it'll, well, there I am.
Yep.
Hey, everybody, very nice to meet you. Thank you, John, for the invitation to come talk today. I'm not good enough at this yet to know whether I leave my glasses on if I can't see my screen or if it's more important that I look like the guy in the picture.
I think you can leave your glasses on, Gregg. We'll forgive you.
Well, I'm going to give it a shot without, because then I can see everybody's face at least. Like I said, thanks, John. Just a quick bio. I've been doing residential real estate here in East Ventura County for about 20 years. I can't believe it's been that long. I kind of got into real estate on accident so my wife could stay home for 2 years with our kids. What that has turned into is now she's unfortunately home with all 3 of my kids, because everybody is sequestered at home. My kids are online learning. I have 16-year-old twin girls. And if this was a normal year, I'd be wishing everybody a happy tax day today, which doesn't even seem like April 15th because nothing seems normal, but it's also my son's birthday. He turned 19 today. Not very excited to be staying at home with his mom and dad. Anyway, John and I were talking about the residential market before the call got started. And I said, it's a little different with residential real estate because we don't get real-time numbers like the stock market. You guys know exactly what the portfolio is doing day to day. You can measure that. We've got at least a 60-day lag in the residential market to see what numbers are coming in and where things are selling. So a lot of what I'll share will be anecdotal, what I'm seeing happening in the market. I have some clients that are pretty big commercial brokers. My brother-in-law is a big commercial broker here in LA. So there's a lot of different moving parts out there. But if you have residential real estate, we really aren't seeing much of a change in value yet. Closings that are hitting now were put under contract 45 to 60 days ago. There's been a little bit of a slowdown in how quickly those things are closing just due to lender constraints and a lot of the shelter-in-place issues that are coming up. In my business, we were allowed, I think 3 or 4 days ago, we got the okay again to get back to work on a very limited basis. We're allowed to show property to buyers, take listings as long as we are enforcing social distancing guidelines, no more than 2 people in the house at a time. That would include myself as a realtor plus a potential buyer, but sellers are supposed to vacate the property for showings. Again, anecdotally, I've got a client who's supposed to close escrow next week on a property. I've got a new property hitting the market on Monday, and we're in multiple offers on a listing in Granada Hills. So there's still activity. It's very hard to know where to get that information from. If I go on Facebook and look at my realtor friends, everybody is killing it in the real estate business. There's lots of great stories, and we just sold this, and it's been our best month ever. But I don't think that's reality of what's going on out there. I have friends who are in the title industry. They said that openings on orders for title, which gets ordered every time you have a new escrow, are at about 50% of where they were the first 2 months of this year. So it really feels like we're down about 50% in terms of volume. But regardless of what's going on with COVID-19 and people sheltering in place, there are still people that have real needs to buy and sell real estate. Whether it's a job transfer, family change. There's not so much of moving mom in with the kids anymore. My mom's 87, lives in Santa Monica. We are unfortunately distancing from her as much as possible, though we go do a drive-by every week and yell at her from the street. Gave her some turkey and ham for Thanksgiving, which we shared from her patio, but not inside the house. What did I want to say? So like I said, there's a big lag between what's happening in my market and then what happens in the real estate market. There are articles out there that say that if you own residential rentals and it's single family homes or smaller apartment buildings, that the delinquency rate for the beginning of April was at about 30%. Now, Normally, we've got about a 13% delinquency rate nationally. That's not uncommon. So really, if it only doubled with with people being out of work and not getting paid since the end of March, I really don't think that's a huge concern. If you end up going 60 days out, if people aren't making their payments at the beginning of May, that starts stretching into the summer. I think we're going to see a big change in now what those landlords have to do. So the first thing that came out was some cities said no evictions. If people can't pay the rent because of COVID-19 or coronavirus, they put a 90-day moratorium on evictions. Not a problem for tenants, but if you own residential real estate as a rental, you've still got to make your debt payment to your mortgagee. I have some friends in the commercial business. One guy owns about 80, not strip malls, but smaller commercial properties, about 1,560 clients in them. And on Monday of last week, so just after the first of the month, the phone call he got was from a little over 200 of them saying they weren't going to make their April payments. And he said he's got 30 to 60 days where that's not a problem, but he made a call to his lenders that day to see if he could sort of renegotiate his payments for the next 2 months. So in terms of the real estate fallout from this, it's almost, it's like trying to find a crystal ball to tell us what's going to happen. It really is going to depend on how long the shelter in place goes and how long businesses are shut down. Because we can all make it 30, 45 days with some loss of income. Maybe not all. Hopefully all of you can. Not all renters can. But if we get into that 2-month period where people aren't making their rent payments, people aren't back to work, where it really starts impacting how people spend their money going forward, I think that's when you'll start to see much more of a shakeout in the residential market. As of right now, things seem to be moving forward very much as usual, but just at a much slower volume. Let me see if I can figure out how to share my screen.
Hey, Greg, can I ask you? So if one of my clients has either an investment property that they're having trouble collecting rent on right now,
right,
or they need to or want to move, would you advise somebody to put their home up for sale right now, or would you advise them to wait in either situation if it was a primary residence or a single family rental?
So I would say, much like you counsel them, it's like how far out are they from needing that money in an immediate way? Selling a house is a very expensive way to access that equity. If they really needed access to equity, I probably would tell them at this point to do a refinance, try to get some cash out. You can still do a cash out refi on non-owner occupied properties. The rates are a little bit higher. But on the flip side of that is the market's high, right? We're at a 10 to 12 year high in the real estate market. So if you were going to be selling it sometime in the next, and my old financial advisor is the house that's going on the market Monday, oddly enough, she needs that money in the next 24 months. If you're going to need that money in the next 24 months, we know exactly what the market is doing today. We know what interest rates are. I would suggest putting it on the market now. And if you don't see the kind of offers you need to cash out what you want to cash out, then take it off and keep it as a rental. But we know exactly where interest rates are. We know where prices are. Again, for the residential side, it's really up in the air where things are going to be in 6 to 12 months. One of my clients is a realtor in the Bay Area. We're helping her sell her father's house in the San Fernando Valley. And she said they haven't seen a transaction in 60 days up there because they got the shelter in place sort of the beginning of March. When it started, the Bay Area shut down. They did the 21-day moratorium. I think it started March 7th, and that's been extended. But she said there's virtually no business up in the Bay Area. But locally, we're at a 12-year high. So, we know what kind of cash you're going to get out of that house now.
Got it. Thank you. Yeah, please go ahead and share your.
Right. See if we can figure that out. All right. Let's see if I share that. There's that. All right. Can people see the Westlake Village home price showing?
Yep.
Well, I'll go back to Ventura County. So as much as I am not a fan of Zillow as a real estate competitor, they are the best people out there at aggregating real estate information so far. So there's still a place I go to when I want to look at trends and what's going on in the market. Now, again, I think there's a lag because if you look in the upper left-hand corner here, they're still forecasting a little over a 3% gain in property values for Ventura County over the next 12 months. I think that's a little optimistic, just given what we're going through. You know, and again, it's hard to dial in and see if it's a 3.2% on the average or the median. That's going to change dramatically based on your price point in our market. But they still have it showing as a warm market for Ventura County. Talks about median home prices, price per square foot. For those of you that have rental property, their market reports, if you go to Zillow Market Report and then type in your city or your county or your zip code, they dial down pretty good. If you look at there, I think the last thing is Ventura County rentals. So, you know, for the county, the average is almost $2,900 a month, which is roughly double the US. I just did a 5-year, but you can go back max and look at as many as 12 years ago. You can pull up just a 1 year and see where things have gone. Again, and John and I have been in a group together for a few years now. The discussion I've had is that I don't think you're going to see much of a change one way or the other in prices. And we started having this conversation 2 years ago, maybe 1 or 2% up or down, unless something dramatic happens, which was before this something dramatic happened. And again, back to your question, John, if you have clients that are thinking of selling and want to know what to do, I'll say again, with the caveat that now we've seen sort of the crisis hit, was that over the last 3 years, I would say that, you know, there's 3 things the market can do. So I can see myself in the photo. Markets are relatively flat. The real estate market could go up a couple points, could go down a few points. Obviously, things can happen that really drop it off the cliff, but very few things could happen that could make it shoot up again like it has gone up over the last 10 years. So I always counsel my clients very conservatively. When we got into the crazy mortgage crisis back in 2006, 2007, out of the hundreds of clients I have served, I only had 2 clients that took a pick a payment loan or a pay option ARM, because I thought they were very risky because you didn't know if you were going to be able to get out of those depending on what the market did. So you're going to get much more conservative advice from me. If you've got to access your money in the next 3 years, now would not be a bad time to try to do it because we know where the market is.
Great. Does anybody have any questions for either myself or Greg about the market or real estate? Some of the questions we could take offline, but some of them we can try and answer right here. If you do, you can go ahead and unmute your phone and say your name.
This is Shelley, and I'm wondering if there's a difference between East Ventura County and West Ventura County at the coast.
I think so.
There certainly is in terms of prices, and it's very, very neighborhood specific once you start dialing down. And that's, if you want to message me any specific addresses you want, I can give you a much tighter look at what those neighborhoods have been doing historically for the last 12 months and where we think we're going. And it really can go block to block almost. Like in the last 6 months, Hollywood Beach has been very hot and Silver Strand has been very quiet. Now, I don't know any reason for that. They're literally blocks apart, walking distance. So it really, you know, like with everything, everything's much more data driven right now. So buyers are going online and looking at these things as well to see what's changing in different markets. I would say many buyers have more information than the realtors at this point.
And then the other question is with the significant Airbnbs at the beach area, what is the impact on the owners?
So the impact on property values has been, I think, negligible. It really, to me, feels like what are the cities doing? to mitigate that. Like I said, my mom lives in Santa Monica, so it seems that there's a new regulation coming out all the time on trying to regulate those. I don't know that they've had a significant impact on property values. We're not seeing as many investors now looking at buying sort of what we would consider second homes, something at the beach, something in the mountains, something in a tourist destination, to open them as Airbnbs, because the cities are being much more restrictive.
Great. Thanks, Shelley. Any other questions, either for Greg or myself? You can also email any questions to me and I'll forward them to Greg. Everybody, all my clients will receive a recording of today's call along with Greg's contact information if you have a question that you want to reach out to him directly for.